Hello and welcome to the very first edition of the Australian Market Digest in video format. My name is Stephen Hogan, author of the Australian Market Digest. You may also know me from Sky Business Channel or CNBC's Cash Flow from Australia, as well as I provide expert commentary to the DowJones newswires as well as the Wall Street Journal. Very proud and happy to bring the Australian Market Digest finally to you in video format. For those who have been following my work for a while, it was previously a written report. We're now able to bring it as a video, which I think is a lot more beneficial to those who read the report rather than going through it in a written format. We can now bring it to you in a video and also step through the process of the charting and the fundamentals as well. And we'd love to hear any requests you might have for the next edition of the digest. Please go to the website www.stephenhogan.com.au and go to the blog page and feel free to make any requests on any shares or indices that you'd like to see in the Australian Market Digest next week. For those of you who are not using our portfolio management services, please feel free also to go to the website and go to fill out a free portfolio review, and we'll go through your portfolio for you complimentary and let you know if your portfolio is suitable to current market conditions. If you're taking on too much risk, look at the fees you're paying, and we'll also discuss our services with you and what we can offer and why we're beneficial, especially in regards to self-managed super funds. Okay. Just some housekeeping before we start in relation to compliance. Just a disclaimer: anything that's in the Australian Market Digest or in the weekly video report, please seek out a professional's advice, your financial advisor or your accountant, before you act on any information that is in the digest, as we haven't taken into consideration your personal circumstances. Like I said, please feel free to contact us if you're looking for a financial advisor. Go to the website www.stephenhogan.com.au and request a free portfolio review. Just take some time quickly just to read the disclaimer before we go ahead. Looking at the Australian market last week, the Australian market ended Friday, the week and the month in red. Australian shares reversed early gains to slip 0.1% on Friday as financials declined in a late session sell-off that saw the benchmark fall 5.1% for the month. Its biggest drop since May 2012, the old selling May and go away, came to fruition, unfortunately. The market was dragged down by concerns over the future of America's stimulus program, a slowdown in China's growth, softening commodity prices, and stock market volatility. Over the month of May, the S&P ASX 200 shed 264 points, and last week had a decline of 57 points alone to finish the week at 49.27. Value of trades on Friday was 8.3 billion in value on volume of 1.1 billion shares at the close of trade. The month of May has been characterised by the US Federal Reserve signalling, tactically or otherwise, it was developing a strategy to exit its quantitative easing policy. This triggered major selling globally as well as locally, and financials and high-yielding industrials were not spared this time around. The market has been driven up by investor appetite for yield over the last 4 to 6 weeks. And we've seen big corrections in stocks recently, such as Westpac coming down from $34 closer to $28 at the end of last week. If we just look at US indices quickly, they fell sharply on Friday night. The Dow was down 208 points or 1.3%, and the S&P was down 23.6 points or 1.4%. Much in speculation that the Fed will consider scaling back stimulus efforts. US stocks also fell for the week overall. The S&P 500 had its first back-to-back decline since November last year. It's an extraordinary start to this year. The S&P 500 slid 1.1% to 1,630 over the 4 sessions, which was shortened with a holiday in the US last week as well. The index did, however, finish up 2.1% for a 7th straight monthly rally, so I finished the month of May up longest stretch since September 2009, which is quite outstanding. The Dow Jones Industrial average was 187 points, or 1.2% for the week, after hitting an all-time high of 15,409 on the 28th of May. Stocks in the US alternated between gains and losses during the week amid speculation about whether the Fed would maintain the current pace of buying $85 billion worth of debt each month or reduces purchases. While economic growth is weaker than economists forecast and jobless claims rose, other data show consumer confidence climbed to the highest level of 2007. Home values jumped the most in 7 years and business activity rebounded. Really interesting situation in the US at the moment. Fed officials have been debating whether to expand or ease off on bond purchases as the economy continues to grow, whilst inflation is staying at reasonably benign levels. Chairman Bernanke has pledged to hold the target interest rate near zero as long as unemployment remains above 6.5% and the outlook for inflation doesn't exceed 2.5%. In my opinion, it would be a little bit silly to stop stimulus right now. Would be very counterproductive to what they've already done, and the US, in my opinion, whilst it's making inroads, it's not at a sustainable level of growth as yet, and it's certainly not out of the water. So they wind back stimulus, you could see a pretty big sell-off in the US market. However, I think the Australian market would be somewhat immune to it. But obviously we're still going to see some falls in our market, but not as heavily as what I think you'd see in the US market if they were to wind back stimulus. SPY futures for this morning are pointing down 57 points on Monday after the sell-off in the US Friday night. I have a feeling it may not be as bad as that though, due to the fact China's PMI data released on Saturday was better than expected, it came in at 50.8 rather than 50.6, raising optimism that the second largest economy may be stabilising. In economic reports this week we have US ISM manufacturing, we have the Reserve Bank of Australia rate decision as well as local GDP numbers. Then in Euro we have GDP numbers as well as the English Bank of England rate decision. And then lastly in the US, at the end of the week, as usual, we have the unemployment rate and change in one-time payrolls. Okay, so let's move on to some analysis now.
Okay, so let's take a look at the XJO, the Australian Top 200, and see if there's anything that we can notice here. In the short to medium term. We'll just also talk a little bit about the long-term expectations on the XJO as well. So we can see there that obviously the market has an obvious support line there of around about 4880, 4900, and we're around about that where that price action is there at the moment. We bounced off there late last week, had a little rally there, and then was unable to go on with it on Friday. So it looks like with SPY futures down on Monday around about 57 points, it looks like we're gonna breach this support level here, and we might end up somewhere down there. However, that Chinese PMI data on Saturday was better than expected, came in at 50.8 with expectations at 50.6. So that may just hold up the market a little bit better on Monday morning. That wasn't taken into consideration with the SPY futures. So market may be a little bit better off than 57 points, but I guess we'll find out pretty soon on Monday morning. So other than this obvious support level here that it looks like we are going to breach, you can see that I put a Fibonacci on the chart there as well, on the daily chart. We can see there that we've already breached that 49.55 level, which is a 23.6 Fibonacci, and it looks like if we are going to head lower, we might end up at this 38.2, 47.70 if the Fibonacci's end up being correct, and a break of that level would suggest that we're going to go down to the 50% level, which is the 46.20. Just take a quick look at the weekly chart. If we look at the 46.20 on the weekly chart, we can see there that that'll take us right back to the 50 period moving average as well. So it looks like we may find some support at one of those levels. Hopefully it's the 47.70 level. I can't see the market going any further lower than the 50% level, the 4600 level, as those high yielding industrials, the big four banks, their yields down at those levels will be very, very attractive. Grossing at those levels will probably be grossing, somewhere between 12 and 13%, including franking credits. So I'd expect very much that those sort of stocks would hold up the market, as they're the ones that have been driving the market up here for the last 6 months. Back down at that 4600 sort of level, we're talking about BHP back down at $30, possibly even lower. CBA back down below 60, possibly closer to 55. Westpac down 24, ANZ back down closer to 24. So you'd expect that the market would come in and support those stocks very, very strongly as we come lower here. If we look at a Gann timing sort of scenario, anyone who knows a little bit about Gann timing, you know that two very significant Gann timing models, the 45 day, and also the 90 day as well. So if we look at the daily chart here on the XJO, we're on the daily. You can see there that we found a high on the 15th of May, which would suggest if we're going to go down 45 days from the high, then we should find a low around about the 31st of the 6th, which, as you're all probably, as everyone's probably triggered, that is the end of the financial year. So that would make a lot of sense. Maybe a bit of selling into the end of the financial year, some mums and dads, possibly even fund managers, just locking in some profits there, maybe a little bit nervous about the market and the winding back of stimulus in the US, and then finding a low right on the end of the financial year. If we look at the 90-day, getting a 90-day correction from the high, the 90-day will take us to the 15th of August, which, funny enough, is exactly 1 month before the election, and when all the opinion polls and pre-polls need to stop. So that could be another key date. A 90-day correction for me right now seems very drawn out, very long. What may end up happening here is we may get some sort of, this may be some sort of A, B, C correction. So what we may see is the market down here in an A leg down to here, some sort of B wave correction, and then a C wave down to this 47.66 level, hopefully not the 4600 level, and that may just be a typical A, B, C correction, and that may be the catalyst to take us down into that 90-day time frame. However, I'd probably see the market first of all finding support at 47.66. And I'd suggest that we probably won't go down here any longer than 45 days. If we have a look at all these corrections here that the market's had up along the way, along this rally, we notice that they're quite short in time, and generally they're not bigger than a 5 or 6% correction. So we're already looking at over a 5% correction here with this move down. So I wouldn't suggest that we go any lower than 47.66 if in fact we don't find support here. So that's why I've been saying recently in the morning notes and the afternoon notes that I would view this as a very strong buying opportunity on the Australian market, especially some of the banks, BHP, a lot of the big brokers at the moment, such as Goldman Sachs. They recently put out a report on BHP. They're switching from Westpac into BHP. I think a lot of these stocks are going to find quite a lot of support down here and a real buying opportunity. So I wouldn't be waiting for the market to hit the 47.66 or the 4600 level before you start stepping into the market. If you've got cash on the sidelines, or you're in fact out of the market altogether, I'd be stepping into this market pretty aggressively at the moment, and not trying to pick a bottom. I'd be very comfortable in the long term here. If you think about it from a long term perspective, worst case scenario, let's talk, if the market goes down to 4,600, you've got a 300 point decline here, whereas long term, we're talking the market up at levels, say, 6,800, 7,000. So, for short-term pain, getting fully invested here at the moment, the long-term gains and the long-term benefits definitely outweigh the short-term. And the problem you have here is if you don't get invested here and we're wrong, and this isn't an ABC correction down, or in fact we don't go lower and the market does find support here at this obvious level, is then the market could be very quickly back up to that 5,200 level, and then you're still sitting on the sidelines and unsure of what to do. So I guess in summary, short to medium term here is if the market doesn't find support here at this 4,900 level, then next level is the 46, 47, 60 level, and then possibly as low as 4,600. And the time frames we're looking for are either a 45-day correction into the end of financial year, or a 90-day correction into the 15th of August. So they're key dates that we'll be looking out for. We'll also be looking out for those Fibonacci levels as well, for the market to find support. If we look down just on the daily chart, you can see here our momentum indicators are very looking very oversold here at the moment, and that's going to look even worse on Monday, I'm guessing. Even though I don't think we'll be down the whole 57 points, I think we're definitely going to be down. So those momentum indicators are looking quite oversold here in the short term. And then we also see a bit of volume here come in around about these levels, around about here, possibly a little bit before on the way down here. So this oversold condition could be the catalyst here for this B wave that I'm talking about. But yeah, I mean, from a long-term perspective, if we just talk about the market from a long-term perspective just quickly, most of you who follow my work will know what I think of the market on the long term, and who follow me on Sky Business Channel. I'll just bring it out to a monthly chart, actually, the XJO, and I can't go out any further than that. So if we look at what the market did during the GFC, obviously we went from 6,800 down to levels closer to 3,000. We then rallied up to the 50% level, almost to the T. If we just put a Fibonacci on that just quickly. Sorry, I'm doing it there. Okay, so we can see there that the market, this is typical. We talked about this, over a year back when we were analysing the market for you all. Is when the market has a big correction like it did through the GFC, generally what it will do is after it finds a low, it will rally up to the 50% level quite quickly, which we can see there that the market did almost to a T, at 49.80 level, 5,000 level, and then it trades in a consolidation for quite a number of years afterwards. And we talked about that in previous reports over a year ago, that the market would do that, and it did it. They are major characteristics of a market that's had a major decline, like a GFC event, and the market didn't let us down with what it did there. What I would say from a long-term perspective now is, I'll just get rid of this Fibonacci. From a long-term perspective, when we look at all the big corrections in the market that gave us this analysis that the market would rally to the 50% level, then trade in a range afterwards, what we also discovered was that the market would go back to the previous high. The market would go back to the previous high within 7 years of the decline. Okay, so obviously the big decline there was at the end of 2007. So if we go out 7 years, that takes us to 2015. Over the last 100 years, any major decline in the market has always gone back to the previous high within 7 years. aside from the Great Depression in the early 1900s. So that tells us by the end of 2015 that we could possibly be up around about that 6,800 level. Looking at it at the moment, it seems quite an unrealistic target by 2015. But remember, that's 18 months away, and the market can do significant things in 18 months. And whilst you think some things aren't achievable when it comes to the market, I can tell you that this market will take you by surprise when you look at how the markets have reacted to low interest rate environments in the past. Markets trade very, very well in those type of scenarios. What we really need now is a change of government, the Australian dollar to come down, and a low interest rate environment, and it's almost like the perfect storm. We'd really like to see commodity prices improve as well, and obviously some good Chinese data come out of China, and they're going to be all good catalysts for the Australian market to really get going here. So there'll be hiccups along the way, and if we don't reach that target by 2015, I would say that we would definitely reach it by 2017, which from some of my timing models tells us that the Australian market will find a high in 2017 before some sort of major correction again. I would be getting, as I said previously when we were looking at the daily chart, I'd be getting fully invested here if you aren't already, on the expectations that this market is going to rally back up to that previous high. And when we look back at history, generally people compare the market to the economy at the moment. Whenever I speak to a lot of people, generally the feedback is, Steve, the Australian economy is not doing well. How's the market going to do well? Well, the economy and the stock market are two totally different things. Generally, when you look over history, when a market rallies significantly, it's when an economy goes into a low interest rate environment where investors are pulling their money out of term deposits, government bonds, corporate bonds, interest rate products that aren't providing them with a good return anymore, and they move to riskier assets such as the stock market, which we've seen over the last 6 months, especially in the banks. Investors will move their assets or move their money into those type of assets, and that sends the market up in extraordinary ways. And economies are never doing well when RBA or central banks are cutting interest rates. So the economy can be not looking attractive, not looking good. That's why the RBA is cutting interest rates. Yet the stock market is doing the exact opposite because investors are looking for good returns. I guess summarising here in the short term, yes, we may see some more short-term weakness here, possibly as low as 4,600, worst case scenario in my opinion. I think the market will find support before that. However, in the long term, we have very, very high expectations of the Australian market, and we'll be having clients invested, fully invested for the next couple of years during that time frame on our expectations. And like I said, there will be hiccups along the way, and hopefully we can identify those and step into the market and write cover calls and generate income and so forth. However, where we're going to get our best returns over the next couple of years is capital gains, and being fully invested in the market at the right times, and seeing that market back up at 6,800. And obviously we look forward to that. So let's take a look now at the major overseas indices and see if anything is popping out at us there. Okay, so let's take a look at the DowJones industrial average, US major indice. Yeah, look, not too much to report there. Obviously, it's been very, very bullish, as we all know, the US markets. I constantly get asked questions in relation to the US market. Why is the US market so strong and the Australian market's not, when our economy is in a much better place? And that just goes back to what I was touching on before. the economy and the share market are two totally different things. When you look at US interest rates have been at zero for quite some time now, since the GFC, as well as stimulus going into their economy. These are things that over time have proven to send stock markets soaring, and that's what we've seen in the US. Difference between the US and the Australian economy is the US has deliberately devalued their currency, which has made their market very attractive. Interest rates are virtually at zero to borrow money over there. And they have the Fed throwing stimulus or buying back bonds and so forth, which also helps money flow into the market as well. So when you look at our market, in my humble opinion, I don't think the RBA has been aggressive enough in cutting interest rates early enough. I think inflation was never going to be an issue over the last 2 years. They haven't been aggressive in cutting interest rates fast enough, and they keep pointing out in their notes from their meetings that they're very surprised by the Australian dollar and how buoyant it's been up at parity. It's because their interest rate cuts at 25 basis points aren't aggressive enough for the market to actually warrant any devaluing in the currency. We should have been at lower levels. We should have been at levels that we're at now, emergency levels, probably 12 months ago, in my opinion. And if we had been, the carry trade in the currency would have not been as attractive. And I think that we would have seen the Australian dollar probably at levels now of around about 80 to 85 cents. So if we do get another 1 or 2 interest rate cuts in Australia, we'll probably see that currency down below 90 cents as well. But moving obviously to the US market, to the Dow here, we're sort of in no man's land at the moment. Very hard to do any sort of analysis on this because it's in a market that's at a fresh new high and at record levels. So. No real resistance that we can sort of look at. In relation to support, we can see that there's a very small support level here and a major sort of support level around about these levels. So we could possibly come back to the 13,500 level. Momentum indicators seem to be telling me that we're overbought at the moment. So a correction could be imminent on the US market. If we look at all the corrections that they've been quite uniform and quite normal, I guess we would say, in the size of the correction and the time. Strong characteristics of a nice bull market the US has given us, and this recent price action has almost been vertical, which to me says, obviously it's still very, very strong. If we were to get a 5% correction, that would work out from the high here. That would work out to be a correction of around about 777 points, which would take us down to 14,765. So in this area here, we'll just go into the daily. So if we were to get a correction, that 5% correction from the high, 14,765, take us around about into this level, which was, I wouldn't really say a support level, but certainly there was some consolidation at these levels, and the market, was really unable to be pushed lower before it started back on its merry way again. So, could be a good support level there. If we were to get a 10% correction in the Dow, it would take us down 1,554 points to 13,988. So basically 14,000, which, funny enough, again is the last point of consolidation, and no real dominant selling in there either. So I guess the elephant in the room with the US market at the moment is obviously, as we discussed when we were wrapping up markets from last week, is are they going to wind back the stimulus and so forth? Which, it's funny the way the US markets are trading. Really, it's whenever there's bad news, a bad economic report comes out, the market seems to bounce on that, basically saying, okay, well then the Fed's not going to cut stimulus because the economy's still in a bad shape. And then when you get a really positive report, the market tends to not act unless it's in relation to employment. The market tends to think that it'll be an excuse for the Fed to wind back stimulus. So basically, the market sort of, for the layman, it doesn't really make sense that the market's basically saying, okay, well, we don't want the economy to improve because we're so bound on stimulus at the moment, and it reacts negative to that. And on the flip side of it, when the economic reports are bad, they're responding, oh wow, we're going to get, the stimulus isn't going to be cut back. So sort of a weird situation to be in. But yeah, I guess that's just where we're at the moment. So sort of in no man's land on the US markets. If we take a look at the market that's being talked about the most recently, I guess it's the Japanese market, and that has really fallen away quite heavily here over the last 2 weeks. You can see there found a significant high, and over the last 2 weeks really been smashed quite heavily. And it's really just been since the government announced there that they're going to target I think it was 2% inflation, which means that they're going to throw a lot of money into the economy. The market's rallied quite significantly, and then the last 2 weeks really pulled back, and it doesn't really leave much support in this sort of area. I mean, we're talking down sort of these levels if we're talking support and resistance. So we've got a little one there, a little consolidation there that the market may come back into here, but clear uptrend there at the moment. Where this will come back to, I'm not really sure. There is an ETF on the Australian market where you can get exposure to the Japanese market. So depending on how aggressive this pullback is, I mean that ETF may look attractive depending on where it comes back to. So we'll just look at the Shanghai quickly. And we see our first higher low in there from the low, from the recent low anyway, which is a fairly good sign. It may be the indication that we're on the way to an uptrend. Momentum indicators are virtually pointing up. The market's tried to pull back here, and in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks. It's failed to really even go back to the low, or basically 50% of this level. So the Shanghai looks quite strong to me at the moment. Don't see any real negatives there. And just lastly, if we look at the S&P 500, it's obviously going to look similar to the Dow, sort of in no man's land here at the moment, at fresh new all-time highs. Clear uptrend, higher lows, all in place here. Higher low, higher low, higher low, higher low. Clear uptrend. Difficult to say where the US market could potentially come back to on any sort of correction. I'd be looking more for a percentage sort of correction rather than support and resistance. So 5% correction or 10% correction depending on the weakness in the US. But my opinion is that the Fed will not cut stimulus here at the moment until that unemployment rate is down below 6.5%. Well, at least we know interest rates are going to stay at zero until the unemployment rate is below 6.5%. I feel that if they were to wind back stimulus and the bond buying program as of now, it's probably going to be very counterproductive to what they've done over the last couple of years, and the economy needs to be in a much more stable environment before they pull back on those, and they don't want to waste everything that they've done so far. So it would be silly to cut it back now, and I think we'll probably see at least another 6 to 12 months of stimulus flowing through, and hopefully they're smart enough to let the market know that, because if they don't, they could trigger a massive sell-off here in the US market. So that's the overseas indices. we'll just look now on the Australian market and see if there's any local shares that look interesting at the moment. Okay, so I guess the first couple of stocks that we want to look at this week, moving down into being stock specific now, is I just want to look at quickly 3 stocks that if you're already using our portfolio management services, 3 stocks that we already have in portfolios, and that is Coca-Cola, Woodside Petroleum, and Santos. If you don't have all 3 of these stocks in your portfolio, you definitely would have 1 or 2 of them. So I just want to take a look at those 3 quickly, because we'll be looking with the Australian Market Digest model portfolio starting this week. We'll be looking to get these 3 in the portfolio as soon as possible. The first one I just want to look at here is Santos, which you can see from the chart. Santos last reported earnings this year of 63 cents per share, which puts it on a current PE of around about 20, which you could argue is a little bit high for exploration and production oil and gas business. However, their assets that they have at the moment, production will be significantly increased here going into 2015. Their oil project, the Fletcher project, has started producing ahead of schedule and it's on budget. Their PNG LNG project, which is operated by Exxon, which is 80% complete, is on track for production in 2014, and their major Gladstone project first production for 2015. If we have a look at LNG on a global scale, production global consumption going into 2020 is expected to be around about 400 million tonnes, of which over 50% of that will actually come out of Asia. So just over 200 million tonnes of consumption will come out of Asia alone. And then if we forecast even further than that, going into 2030, global production is meant to increase up to around about 600-700 million tonnes, of which 69% will come out of Asia alone, and will reach around about 338 million tonnes just out of Asia. Santos and Woodside Petroleum are obviously two of the major LNG producers here in Australia. And Santos, I think over the next couple of years is really going to become a cash cow for investors. Management has flagged the fact that they are expecting to increase dividends to shareholders and increase their payout ratios as these assets come into production. So I think it's definitely a really good one to have in self-managed super funds here over the next decade. Albeit it hasn't done much over the last couple of years and probably disappointed investors, but you've also got to understand that their major projects aren't hitting the market until 2014-2015. So now that they'll be coming online over the next couple of years, it's some exciting times for Santos and the LNG sector itself. If we just take a look at the chart here quickly, you can see that the share price found support here at $10. Which was quite an obvious support level there from back in 2011, and we can see there that we're in a clear uptrend here at the moment, albeit not a very strong one, but we can see that higher lows are in place there, signalling a clear uptrend. So this the share price here, on any pullback here that we do get in the market, we'd expect to see Santos hold up above this $11.50 level. I have long-term targets by 2017 up above $20. I think it'll be closer to 21. Short to medium term targets up around this $15.50 to $16.50 level. So that's one that we'll definitely be looking at getting in the model portfolio as soon as possible now that that's online. And the other one I want to just look at quickly here is Woodside Petroleum. Woodside Petroleum management was very, very smart recently, increasing their payout ratio to 80%, increasing dividends, and announced the special dividend there of 63 cents. That's what the market's looking for at the moment. companies that are paying good dividends, and Woodside Petroleum, over the next couple of years, I think is going to be a cash cow as well. And similar sort of chart to Santos here, where we found support at obvious levels here around that $30 level, obvious buy down there, and then we're seeing higher lows in place, as you can see that I'm pointing out there, and finding support on this 50 period moving average as well. I'd expect to see Woodside Petroleum hold these levels here. You can see previously it acted as a resistance. This $36 level should now be support. Worst case scenario, we come back down to this previous higher low of $34. I have targets on Woodside, long-term targets on Woodside Petroleum up above $50, closer to $55. So I think it's a bargain here at the moment, and this is another one that we'll be looking to get into the model portfolio as soon as possible. I'll just go into the energy sector just quickly, because I mentioned that I'm quite bullish the energy sector. So if we look at the XEJ itself, long period of consolidation here where we haven't seen much price action, but now we, similar to Santos and Woodside Petroleum, we're starting to see higher lows come in, signalling some accumulation, I guess, and an uptrend, albeit not very strong one, but as we sort of come out of this price range here, I think once we break this level here, the 13,694 level, that previous high, and we start to move above this, it'll really become quite strong. And as there's more investor appetite for a bit more risk, as the market goes from the bull market goes from phase one, where clients or investors just look strictly for yield and safety, moving out of interest investments to risk to the share market, and there's more appetite for something like Santos and Woodside Petroleum, you really start to see this energy sector really start to take off. And by 2015, 2017, we should be back up at this level again here at the previous high, up closer to 18,000, which would be in line with Woodside Petroleum and Santos meeting my upside targets there as well. So as you probably know from seeing me on TV, really bullish the energy sector here over the next 5 to 10 years. So we want to be overweight that sector and have definitely the key players in that area, Woodside Petroleum and Santos in the portfolios. Okay, so lastly, we just want to take a quick look at Coca-Cola here. As I flagged previously, 3 stocks that we have in most clients' portfolios, as well as we'll be looking to get in the model portfolio as soon as possible. Now that that's launched this week, is Woodside, Santos, and Coca-Cola. If we just take a look here at the Coca-Cola chart, you can see here there's an obvious support resistance line at that $12.50 level. Previously was a resistance, broke through that level, kind of bounced off there, I guess you could say, a little bit higher than $12.50, and now we're back down at this level at the moment, after that recent sell-off from Coca-Cola's trading update. If we just have a look at the trading update, Coca-Cola flagged basically the first 4 months of trading had delivered mixed results. The highlight has been the continued strength in the Indonesian business, which has generated volume and revenue growth of over 10%. I guess what concerned investors mostly was in the Australian beverages. The grocery channel has experienced a very difficult start to the year due to the continuation of higher levels of competitor discounting. And that's obviously had an impact on their underlying. Whilst I can understand the market reaction to the trading update, basically saying that earnings are going to be roughly in line with what they were in 2012, I can understand the disappointment to investors, but we now have to look at that as an opportunity to buy a great business that has such a large monopoly on its market. Despite the fact that competitors are discounting their product, I mean, certainly Coca-Cola has the opportunity to do so as well, and could possibly discount their competitors out of the market if they so wish to. If we take a look at the chart, obviously that significant support line there, I can't see us breaching that. Would be very surprised if we were to do so. And if we look at the momentum indicators down there, we can see that we're in a typically very oversold environment here at the moment. If we take a quick look at the fundamentals of the business, obviously we can see there that Stock Doctor is telling us that the company's in a very strong financial position, which is obvious, being Coca-Cola. What I really like about the business is, if we take a look at the profitability ratios, such as return on equity, over the last 5 years has been very, very good, over 35% consistently. Early on in the piece there, 2008, we're even up over 40%. 2012 saw us slightly down at 37.7, and I guess if we look at this figure here, that's what's really concerning investors, is that earnings per share growth for 2013 is going to be negative 1.46%. Is that bad? Look, certainly we like to see consistent earnings per share growth with any of our investments, but look, we all we can understand 1 year of negative growth where competitors come into the market and highly discount their products and so forth, and if anything, that opens up a lot of avenues to management to take a look at what they're doing, possibly improve some of their aspects of production and so forth. So this may just highlight to management some key aspects of the business that they can improve on. So whilst it's a short-term negative, if we look here at 2014 for forecasted earnings per share, we're meant to see growth again, back up at 7.3%. So that's really positive. And we've also got the yield down here of 4.34%, which will be closer to 5% come 2014. I just view this as a very good opportunity to buy Coca-Cola off its highs. We saw a high there of $15.43, and we're down below $13 here at the moment. So good opportunity to buy a great business like Coca-Cola off its highs, and a bit cheaper. Over the next 5 to 10 years, I think Coca-Cola will be trading way back up above $15 and closer to that $20 level. Possibly even for your short-term traders out there, a good trade back up towards $14, $15 as well. And you can have a stop loss just below this $12.50 level. If it breaks that, then you may just want to be out of it, because possibly it could come back into this region here, where it's previously found support. But yeah, great business, and one that we're very confident in having in long-term portfolios, and even a great risk-reward trade for short-term traders out there at the moment. Okay, so that's all the analysis we have for you this week. Please feel free to visit the website there, www.stephenhogan.com.au, and what you can get from the website there is a members login area where you will be able to see the new Australian Market Digest model portfolio at all times. We'll put what positions are currently open, closed positions, how the portfolio is running, as well as the afternoon and morning reports go in there, as well as the video reports that we're doing now. We'll also go into the members area. You can also visit the blog as well. We're always happy for clients to go into the blog. The morning and afternoon reports go in there, as well as if you want to get some analysis on a certain stock, please feel free to visit the blog and request it through the blog. And if you're totally new to the Australian Market Digest, or you've just seen me on TV recently and requested to receive our reports, or you're interested in our portfolio management services, please remember that you can request a free portfolio review. And in the review that's complimentary, we'll discuss if your portfolio is suitable to current market conditions, if you're taking too much risk, what fees you're paying, evaluate your current strategy, and the benefits of using our services, as well as writing covered calls against your portfolio. And you just go there you can fill out that form just at the bottom there and submit that to us, and we'll receive that. Also, just on the home page as well, if you go down, you'll see there's this box here, Sky Business Channel, and on there we'll be updating whenever I'm making an appearance, whether it be Your Money or Call, Market Moves, or CNBC Cash Flow from Australia, which goes all around the globe. We'll be updating you and letting you know when I'll be on there as well. And then, of course, we always put the CNBC shows on the website as well for all of you to view. So yeah, please feel free, if you're not already taking advantage of our portfolio management services, to request a free portfolio review so I can discuss your portfolio as well as our services with you. Or if you'd like to request a more formal meeting, please feel free to email me or give me a call. Okay, so that's it for this week's very first edition of the Australian Market Digest in video format. I hope you all enjoyed it. If you have any questions, please feel free to go to the website, www.stephenhogan.com.au, or if you've got any questions, obviously, regarding our portfolio management services, we'd love to hear from you. And you can fill out the free portfolio review on the web page there. Signing off for the week. See you on Sky Business Channel or CNBC, or in the video report next week. See you later.